You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com. as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to check out on said network, including hundreds of archived hours of this here program, Volatility Views, for you guys to download or stream, whatever your heart desires, and pretty much wherever you like to find your favorite audio content, we should be there. So that includes, of course, our mothership site, theoptionsinsider.com, Insider Radio Network tab, top left corner of the page. It's all broken down there for you. Of course, also iTunes, TuneIn, Stitcher, et cetera, et cetera. I will say over the holiday weekend here in the States, I had a fun experience where I picked up one of those Amazon Echo devices, and I was able to literally just say, Echo or Alexa, play Volatility Views in my living room, and it was able to stream it through TuneIn. That was a pretty fun experience. We're available on pretty much every platform you can think of, including those devices that will beam the show directly into your own living room or kitchen there. So no shortage of fun ways for you guys to check out our content. And of course, if you want it all in one place, just grab our app available for iOS, Android, and the Fire OS. And of course, baked into the app is all that great feedback stuff. We're always talking about email, social media, et cetera, et cetera. You can reach out with your questions, your comments, your insights on volatility, not just for us, but for your fellow listeners. And joining me on the old Volatility Views program today, let's start off in order of distance. Let's go closest to home here. Closest to the Options Insider Radio studios here, we are joined by the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com, as well as myriad other ventures. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
Hey, thanks, Mark. It's good to be here, enjoying the day. This is quite the face ripper we've got going on here. Really interesting watching kind of everything collapse and everybody basically get short squeezed out. We've had two huge short squeezes this week, so lots of fun stuff to talk about.
Yeah, on the heels of the big vol explosion yesterday, now it's the big vol implosion. So they giveth and they taketh away just in a 24-hour period, which we love, that schizophrenic nature of the volatility market. And going in order of distance, he actually gets pride of place for being our farthest guest, at least on the Volatility Views program from the old Options Insider Radio HQ. He's our usual co-host here, compatriot here, Mr. Russell Rose, but he's not beaming in from the corner office down the road at the CBOE this time. No, he's beaming in from his new corner office over there in Singapore. So, Russell, welcome back to the program, and I'll give you your virtual feather for being indeed our farthest traveled, at least virtually, guest here on the program.
I get a gold star, which will get me, I don't know, a half a Starbucks or something like that over here, which I could use right now because it's 2 a.m.
Yes, I was gonna say,
jeez.
you also get points for coming on at 2 a.m., which is also that shows your commitment to the volatility cause, sir.
We'll get you a Red Bull when you get back, okay?
Gosh, that would be nice. All right. So
Russell, of course, was overseas for the big RMC Asia show that he will give us a rundown for in a little bit. But before we even get to that, we've got a great guest lined up for our Volatility Viewpoint segment. So without further ado, let's get right to it.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to the Volatility Viewpoint. You guys know the drill by now. It's the portion of the show where we welcome on guests from throughout the world of volatility. They could be practitioners and traders or researchers and academics or somewhere in between. And we proceed to pick their brains for the benefits of you, the listener. And today's guest is an old friend of the program, even though he hasn't been on in quite some time. We've been remiss in rescheduling him. He is Chris Cole, the Chief Investment Officer over there at Artemis Capital Management. Chris, welcome back to the Volatility Views program. It has been too long.
Thanks. It's a pleasure to be back.
And you kind of get the Goldilocks Award in terms of distance. Mark's here in Chicago, Russell's in Singapore. You're in Austin, Texas, so not quite the middle, but at least somewhere in between.
Somewhere in between, yeah. It's although recently just came back from I was with Russell in Hong Kong for the CBOE conference, so I'm still a little bit jet lagged myself here.
That's true. You do get the Globe Traveler Award. You and Russell both get gold stars, which you can turn in at the Options Insider store for a nice fleece or something else of your choosing. We'll have to see what the cash value of that is. But Chris, like I was saying, it's been a while since you've been on the show, so we probably have quite a few listeners who aren't familiar with you and what it is that you do over there at Artemis. So maybe let's start there by taking a step back. Why don't you go ahead and give our listeners a little bit of an overview of your background in the space as well as what it is you guys actually do over there at Artemis?
Sure. Artemis is a private investment partnership that focuses on long volatility trading strategies. So we have an emphasis on the VIX and V2X, but our focus is really trying to provide convexity and long vol exposure to our clients.
I like it. Nice and succinct. That's I always like when a guy can sum up his investment objective in 30 seconds or less. Well, Chris, there's a lot to get to. But the reason we really wanted to have you on the show is going back to your letter to your investors from a few months ago. It was kind of coming out of the heels of the big sell-off in August. The market was in a tizzy. A lot of people were speculating about a lot of interesting things. And you wrote a letter to your investors, which was then picked up through one of our favorite, with an asterisk there, outlets, Zero Hedge. That's how I first actually came across it. So whenever I come across things from the first lens being Zero Hedge, I always take it with a bit of a grain of salt, which is why one of the reasons I wanted to bring you on the show, so maybe you can clarify a few things for us. But they took your letter to your investors and really ran with it in a series of articles, and as they are wont to do, really ramping things up a notch, getting into I think the article they called was Moral Hazard, Supernormal VIX Swings, and Why August 2015 was Just an Appetizer. And I'll just pull a few choice quotes out from this letter of what you wrote to your investors here, Chris. Then I'll let you kind of run with it and kind of summarize for our listeners what you were actually thinking of. There were a lot of nuggets to pull from here. I only grabbed a few. The first one I noticed was that you wrote, "I firmly believe that this moral hazard produces a hidden leverage and a," quote, this is probably my favorite term, a, quote, "shadow market gamma that at some point will result in a sustained volatility outlier event in the opposite direction." You also say central banks refuse to let volatility remain elevated, but this is creating a new set of shadow risks that global central banking has artificially incentivized bets on mean reversion. And there was a lot more going into it. You had mentioned the moral hazard argument of the Fed essentially wagering or supporting those bets on mean reversion and creating this shadow volatility gamma. Again, I love that term. There's a lot more data in there that they reference, but I'll let you kind of take it from there. What was your thought process behind this letter, and then what was your second thought process when you saw the guys over there at Zero Hedge really took it and ran with it, perhaps in a direction you never initially intended?
Yeah, I think first of all, it's a white paper, so it was intended for general consumption. I just want to make that clear. I spend a lot of time writing my investors monthly, but this very much was a paper that was intended to be quite public. So entitled "Volatility and the Allegory of the Prisoner's Dilemma." In fairness to Zero Hedge, I'm alarmed. I think that I think they have created a tremendous moral hazard in markets today. I think that it used to be that central banks would respond to economic conditions. And they stopped responding to economic conditions, and they started responding to any fear that developed in markets. And we've seen this over the last 3 years. Every single time that there's any type of minor problem in markets, a central bank, a global central bank, not just the Fed, but a global central bank suddenly swoops on in to save the day and floods the system with liquidity, causing a massive rally. And this expectation of central bank support is embedded in markets. And this is very dangerous because it produces a kind of hidden leverage where you have, one example is the growth of the short exchange-traded product space. For the first time in history, actually the second time in history, but more so this time, short exchange-traded products outstripped long exchange-traded products. That's incredible in the VIX space. This is the idea that people now feel so confident shorting vol that they do not feel like there will ever be an issue with an extended drawdown, or that volatility will get out of control. And this produces a kind of potential for crisis and a ramp up in vol that I think is hidden to market observers, and I think is actually a source of great risk.
So you think this flood, this explosion that we've seen over the past few years, not just of VIX and volatility-related ETPs, but as you mentioned, the inverse and the levered inverse, the short 2, the short 3, these types of products, you think all of that is pretty much directly attributable to some of the easing policies and everything else that the Fed has been up to over the past few years?
Yeah, absolutely, because it used to be back in the day that you could achieve your return target by, say, investing in investment-grade corporate debt, or even investment-grade corporate debt. You get over 5%, 6%, 7%. Well, today you've got to go out further on the risk spectrum. You've got to go out further on the credit spectrum, or you have to look to shorting volatility. So vol has become just a short yield play, a yield play in this environment. And you have people pouring into areas of risk they don't truly understand. And this produces, I think, a unique potential of being able to take the opposite side of that position to make money when volatility potentially explodes to the upside. But I think the moral hazard has been fully embedded into markets at this juncture. It's really interesting to look at in August 24th when vol spiked up above 40. What's interesting about that period is that we had the greatest inversion in the vol term structure in history. VIX futures discounted the move by about 15. There's a far greater discount than anything anyone experienced in 2008, 2011, or any other period. So the idea that there was going to be a response and there was going to be a rally was already baked into the market for forward volatility. And what's incredible is we got that rally in a way that even exceeded what the VIX futures market had expected. Now, if you want to look at what the tail event was, in this summer, it was not the rise in vol; it was the collapse in vol. That collapse in volatility is truly unprecedented. You can go back across history, and if you look at the price graph on that vol spike and the quick decline in volatility, it does not look like a market endogenous event. It actually looks like some sort of market exogenous crisis, maybe a natural disaster or terrorist attack, where people get terrified and then come back to their senses to understand that it won't have an economic impact. Looking back across history, I think one of the only instances I found that mapped onto it was Pearl Harbor. We experienced the number 1 ranked peak-to-trough drawdown, which was a power law violation during that August to September period. There was a 10-day decline in VIX. We experienced the number 2 ranked drawdown and the number 9 ranked drawdown. These are massive drawdowns that are rare events in their own right. I mean, that's almost like a 9.0 earthquake, 10.0 earthquake, and an 8.0 earthquake all happening in the same 1 or 2 month period. And these earthquakes are declines in volatility. What drives that? I'll tell you what drives it and answer my own question. I don't think you get that type of vol collapse if you don't have China's central bank spending an estimated 15% of their GDP to prop up their stock market for a military parade. I don't think you get that type of response in vol if you don't have the Fed refusing to raise interest rates off of 0, or the ECB then promising additional QE, a coordinated effort by global central banks to collapse volatility. What's happened is now you have this embedded moral hazard where everyone now feels comfortable leveraging into sell-offs, shorting volatility, and are adjusting VAR-based models or volatility rebalancing-based models based on artificially lower volatility levels. So this creates a kind of hidden risk. Yes, I mean, things are good. They've taken, they've managed to calm markets, but what they're doing is they're taking risk today and pushing it into the future. And they're taking asset returns from the future and they're bringing them to the present. And the question is, how much longer can they keep this up?
Well, there's a lot packed in there, but I know I can see Russell all the way from Singapore. I can see him chomping at the bit to get in. So, Russell, go ahead, sir.
Oh, I'm not chomping at the bit, but I just what I find interesting is I have a little bit of an advantage here because I got to hear Chris speak earlier this week and on the same topic. Chris, we had VIX implode, but the futures kept going up and VXX actually kept going up. And and you're a long vol guy. Does that mean that when we get the first move up, and things are discounted so much that in the tradable products you're able to take advantage of that still, even after the first spike up?
Well, I think VIX underperformed the week of the spike. The VIX futures dramatically underperformed the week of the spike.
Yeah, on the way up,
definitely. Yeah, on the way up.
Yeah.
But I mean, part of that was also related to the timed expiration on that future, though. I mean, it had just become the front month. So
yeah, but even if you rebalance for that, it was the most dramatic underperformance of the product. So even if you rebalance with it, you're right about the timed expiration. Had that spike occurred during expiration week, I think you would have seen better performance.
Right. Yes.
Yeah, it would have exploded. And certainly the weeklies did explode, in correspondence with spot vol. But I think that even if you adjust the performance of the VIX futures for time, there was still a dramatic underperformance compared to previous crises in 2011.
Actually, Chris, let me throw this at you. Maybe the existence of those weekly futures could have contributed to some of that underperformance. The idea that the true panic buyers of VIX futures maybe attempted to move in different areas. Now, I know there was not the same type of volume that you'd see in the normal futures, but maybe it wasn't a major contributor of this event, but I could definitely see that affecting things. And then, I would say that one might actually look at VIX itself and say that the black box movement of the S&P 500, the crazy auto trading the S&P 500, maybe contributed to the VIX maybe being higher than it should have been, even with that kind of intraday volatility. Because if you look at where realized volatility ended up, a 40 VIX was too high.
I actually, it's an interesting framework though. The S&P really didn't move that much.
Right.
I mean, it was a peak to trough 10% drawdown, right? So the vol of VIX was particularly pronounced given the move in the S&P.
Yes.
And this gets back to this concept of, hidden convexity. So what are reasons why is VIX having spasms? Why are we having these spasms on relatively low movements in the S&P 500? Right? I mean, 10% peak to trough drawdown in the S&P, that's nothing. That doesn't even register as a blip in the realm of crisis.
I mean, you have a lot of people hedging long-term, paying for long-term hedges with short-term premium, and I think that in the S&P itself, and I think that's one of the major contributors to some of the movement we've seen. We've seen a lot of these funds come out that are going out and buying 3, 6, 12, out to 24-month puts. And they're paying it with covered calls and different types of pieces in 30 to 60 day. And I'm wondering whether the fact that there's the market essentially has on a massive time spread, whether you think that could be a contributing factor to this.
Yeah, I mean, I think that's a great point. I mean, that's a really interesting point. I mean, I would think that one should be doing the opposite.
Yeah, a lot of people.
I would say, why are people? Yeah, I mean, it's pretty funny, but the framework being is that absolutely that creates this dynamic where people all of a sudden have to cover these short vol positions on the front. I do think the idea of short volatility in all its forms, whether people are shorting for income, whether they're shorting to pay for a longer dated hedge, whether they're speculatively shorting through XIV, I think it's interesting that it does create these kind of huge short covering rallies and these spasms. I don't think we can blame everything to just short vol. I think that's one factor among many, but I think that's the factor that is within our scope of knowledge.
Now, Chris, there were a couple elements I wanted to get into with regards to your paper, and Mark just touched on one of them, which is we're in a bit of a new regime these days where short duration is the name of the game. It's short. It's weekly this, it's weekly that. We, of course, are in a new era now. We have weekly VIX futures, and we just listed the options a few weeks ago, as Mark just touched on. Some of that could have, tampered or muted down some of the impacts on the mothership VIX product, if you will. So I'm curious what your thought is on that now that we're in this kind of new environment where short duration is kind of the norm, how that perhaps is impacting these swings that you're detailing here.
Well, that's an interesting point because there's this frenzy for theta decay. There's this frenzy for decay to pick up that premium, and the shorter you get, the more of that decay you're picking up, right? The more sensitive you are, per unit of theta per time, but at the same time you have a lot more gamma risk. So that's in many ways people are in an environment where vol has been artificially suppressed. People the idea of picking up quick decay for excessive gamma risk looks really attractive, or artificially attractive, and that might be in all of its forms one of the reasons why you might be seeing this type of a spasm effect. It's interesting the idea that the CBOE changed the calculation on the VIX itself last year in October, and now the weeklies are part of that. So that's actually in some instances actually impacted the vol of the VIX itself. Although we've seen similar kind of extreme movements in V2 and V stocks and in the old VIX methodology, so that's not all to blame. But I think some of the intraday gyrations of the VIX itself might be kind of quirks based on the rebalancing of the weeklies that it now uses in the calculation there.
Yeah, that's something we were all kind of concerned of here when we first heard that they were going to throw the weeklies into the calculation, all of us here kind of scratched our heads and said, that sounds a little crazy, till we actually heard what they were actually doing. It wasn't what we thought. They were just going to throw, the SPX weeklies into the mix, but they're going to do it a little bit differently, add a little bit more nuance there. But you're right, it has made the product perhaps a little bit more interesting after that addition. But, looking forward a little bit, you write about, the Feds and their impact, the collective Fed around the globe, and their moral hazard, and their essentially incentivizing a mean reversion. Now, we've seen a lot of big Western, Fed, at least here in the States, say they're stepping back from that, stepping away from that. Of course, we've seen Europe and others not doing that so much. So I'm curious, is this something you're still concerned about going forward? Do you think if we have, another major event in the marketplace, the Fed will step in yet again, even though they've kind of come out and said they're out of that business now? Or was this kind of a finite moment in time that caught your attention?
Well, as I sit here, the Taylor rule says we should be at a 3% Fed funds rate. So, and we're at 0, and they have yet to raise rates. And just because they raise 25 basis points doesn't mean anything. That's still incredibly low, incredibly accommodative stimulus. And the market goes into a complete frenzy yesterday when Draghi doesn't dramatically increase QE in Europe and only merely, cuts the deposit rate a little bit. We're talking negative rates and QE, and the market spazzes out, right? If we were having this if you told me that we were having this conversation 10 years ago, I'd be like, that's laughable, right? So I think the concept of them removing stimulus is, what does that really mean? I'll believe it when I see it. So, and whether or not they truly go through with that, I think is a big question. And even if it's raising 25 basis points, does that really indicate a rate hike cycle? Which I think is something very different than taking a baby step here, which is something they haven't been able to do even now.
Okay, all right. I'm going to jump back in because we went a different direction. I don't think we ever really got to what my original question was. Do you think that, of course, this is a bad example right now with the S&P 500 up like almost 2% and VIX getting crushed. But do you think there are going to be opportunities where you see VIX go up? And, we normally don't like to buy what looks like breakouts on volatility markets, but you can actually maybe get long in this environment because you've got so many people conditioned to sell volatility when we get the spike. Just going forward, do you think that's something that people are going to be able to do, Chris?
Yeah, I think this is the way it's going to work. Is that I think you're going to have a continued situation where, there's a spike, people short it, great, that works. And when it doesn't work, you're going to see the most massive short covering that you've ever seen. I shouldn't say that. In 1987, VIX went from 30 to 150, so I shouldn't say that. That's not responsible of me to say that. But I think we might see an event where, absent some sort of immediate central bank response, in the advent of crisis, you see people vol go up to 30. Everyone begins to jump in and short it, and the crisis continues, and you might see it go straight up to 80. And I think you might see some of these ETP products taken out overnight.
Oh, some of the ones
we're
that
much closer to that environment than most people imagine.
So as the Fed, sorry, Russell.
I was say some of the ones that have, is it XIV that has that knockout on it? Yeah.
Yeah, they can't go past 0. They have a floor there. So in some ways,
they lose 80% in a day. They have to.
They lose 80%. Yeah, so they have a put option at the 20% level. That's sort of like it's an implied kind of put on the position. You're not going to lose more. But I think given the type of buildup that you see and the type of conditioning, could you imagine? I think there's a graph in the paper that shows the '87 crisis, where vol went from 20 all the way up to 30 over 1 month, and in one day it goes from 30 to 150. That's the type of dynamic where you have this kind of built-up leverage in the system and this self-reflexivity. Back then it was portfolio insurance, and there was a confluence of events. But I can imagine a situation now. You have this confluence of self-reflexivity ranging from short volatility and the people who need to cover that. You have this shadow convexity that comes from risk parity rebalancing, VAR rebalancing, and all of these other strategies that rebalance based on vol. And you have now this kind of conditioning in markets, a Pavlovian conditioning, where everyone's just supposed to short volatility the minute it hits 30 or the minute that it breaks out over some historical trend. So you could have a situation where vol jumps on up. Everyone begins to short it, just like they did this past August, September. Like after the fact, the short interest expanded, and everyone's anticipating some sort of central bank reaction function, and they don't get it. And you end up in a environment where vol is then doubling or tripling, and you have really another kind of hyper crash, not a 2008 type of crash, but like a 2010 flash crash or 1987 type of event, where it's an explosive type of move. And I think that the more that they kind of press the stimulus button here, or the more they delay removing the stimulus, the more that this potential kind of vol breakout becomes a potential reality.
It is a scary prospect, but you're right. We are in this kind of environment where, volatility is discussed on almost casual basis on a variety of mainstream outlets and things. And when it gets into the mid-20s or like you said, that 30 level, it automatically kicks in that, it's marketed as a mean reverting asset. So people have this natural expectation that you're right, it will aggressively revert down to somewhere in that 15 to 20 range. And we see the paper lining up as a result. So you're right. There is a bit of a danger lurking in that collective expectation for volatility and VIX to perform one way. And then, of course, when it doesn't, that's when it wipes out a large number of people and, of course, a large number of those products you're talking about. Of course, I'm still amazed to this day. People didn't learn about the hazards of some of the funky structures of some of these ETPs on vol from the big TVIX fiasco. Then they're never going to learn, regardless of what we say on this program or others. Chris, this is fascinating stuff. I could probably go on about this for another couple of hours, but I do want to get on a rundown of RMC Asia too. But before we step away from this, I'll give you a chance. Any last thoughts you have? Anything else you want to convey to our listeners on your white paper on this topic? Go ahead, sir. The floor is yours.
The one thing I really want to remind people is everyone talks, there's this idea that long volatility and being long vol is so damaging, and that you have to be wearing a tinfoil hat. The truth is that if you took a long vol portfolio like the CBOE Long Volatility Hedge Fund Index, and you paired that with simple exposure in the S&P 500, from 2007 to today, you'd have a much better return than you would in a hedge fund, the average hedge fund. So long volatility exposure, active long volatility exposure, plus the S&P 500 dramatically beats out the S&P on a risk-adjusted basis and the average hedge fund on a risk-adjusted basis. So I think the idea of pairing long vol in a portfolio is really powerful because of its anti-correlation. And I think if there's a point to do it in the cycle, it's probably now. I don't know if it's going to be a year or 2 years, but this is starting to get pretty long in the tooth, and I think people should be thinking about this right now.
Well, if people want to learn more about what it is that we're actually talking about or read the paper for themselves, like Chris said, it is called Volatility and the Prisoners and the Allegory, of the Prisoner's Dilemma. You can find it over there along with everything else Chris does at Artemis, ARTEMISCM, capitalmanagementthere.com, and to scroll down to that paper. be warned, it's a dense read. It's 30 odd pages, I believe, and as Chris is known to do, he does load it up with some nice visuals for you to make the reading a little bit more interesting. In fact, Chris, I was just looking at that 1987 graph you mentioned here and the horror of it. So there's a lot of great visuals if you want to just go look at the pictures. It's also a fun one as well. Well, Chris, that's fantastic stuff. I'm looking forward to hearing about that. But also, we have Russell joining us, and we just found out before the show that you just came back from Hong Kong as well, and both of you guys were knee deep in the new RMC Asia event. So without further ado, I think we'll devote our volatility review segment this week to some breakdowns of some of the really cool stuff coming out of that event.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, a little bit different volatility review this week because there's so much going on in the world of volatility, not just in the trading side, but also on the big conference and research and event side. And Russell was kind enough to stay up till 2 a.m. Singapore time to fill us in on the latest goings on. So, Russell, before you pass out at your keyboard, let me give you pride of place here. You spent the better part of the week there at the new CBOE Risk Management Conference in Hong Kong. I saw some interesting tweets and other things coming out of it, what people were talking about, but I'll let you have the honors. What really caught your eye? What were some of the interesting conversations going on at the RMC Asia event?
Well, of course, Chris's presentation was by far the very best thing of the whole conference. So, and we've already spent a half hour on that, so we'll move on. But no, Chris did an excellent presentation, and everybody's heard a good portion of it already. So I do want to acknowledge that he was there in one of the highlights of the conference. What was really interesting? Well, the first day, I actually had my first time in front of everybody at Risk Management, and we will see in February in Florida if I'm on the agenda again. If I did an okay job, but they wanted me to come in and talk about just the volatility markets, because the listed volatility markets over here are not quite what they are in the U.S. And I got a lot of good questions during, and a lot of good comments during the breaks as well. A lot of good informed questions about how our markets work. We had a panel on options and market volatility structure that had one participant from China, and then one from Europe and a couple from the U.S. It's really interesting how different the markets are over here. They have a lot more structured products that change kind of the nature of the order flow. So you get different. There's a Hong Kong volatility index on the Hang Seng, and the price reactions out of that are a little bit different than what we see with SPX and VIX. And learning a little bit more about why that is, that was probably the most useful thing for me. They talked about how the market is still in the development process in China, and one of the funniest comments in a side conversation I heard was they kept talking about how the Chinese government wants to make sure that people are not taking on too much risk, and one question was, well, what do they consider too much risk? And a guy from China said, well, I guess it's just whatever the government says is too much risk. I just the way he said it a lot better than I just did, but it was interesting. Too much risk is what the government says is too much risk. Buzz Gregory from Goldman Sachs gave a overview of the volatility markets and talked a little bit about 2016. He hasn't put his official forecast out yet, but I think something that was kind of telling was he said this was one of the more difficult forecasts that he's ever had to put together. And I think there's a lot of feeling as far as that goes. Is nobody seems to be bullish on stocks going into 2016, but I don't. Maybe it's just because we've gone up for much longer than anybody expected us to. Nobody wants to go out on a limb and be more specific than that right now. So a lot of uncertainty going into next year, which if we're going from a low volatility regime to a high volatility regime, that's how you get there, is more uncertainty. So that's kind of a high level overview of everything that occurred at RMC.
Chris, same question for you. You just got back from Hong Kong, so you're still a little jet lagged yourself. Obviously, you gave your presentation we talked about here down at RMC. So aside from your presentation, which I'm sure had some great visuals and maybe even a video or two, I know you've been known to do that in the past. What else caught your eye? What were some of the fascinating conversations and topics you heard over there at the Asian version of RMC?
Yeah, and Russell gave a great talk as well, and I think what's interesting is that as Russell kind of pointed out, is the prevalence of auto callables and structured notes in the Asian market, how different that is really interesting and something to learn about. The idea that short volatility strategies, which have been kind of packaged in these structured notes. In Asia, they've been predominant in Asia over the last decade or so, and it's interesting because it's kind of a parallel for where the U.S. has been going, because people use volatility where they don't have the income from fixed income investments. If you look at, for example, JGBs, they don't yield anything, so then people turn to these structured notes where they sell volatility as a form of yield, and it's delivered in a structured note that provides that exposure, and how this creates certain anomalies in Asian volatility markets, as Russell pointed out. It's a very interesting to be able to talk about that phenomenon with market participants over there, and how different it is from U.S. vol. And I think Russell gave a good overview. I think Buzz's presentation was fantastic. There were some interesting presentations on volatility of volatility as well, and it was just a good solid meaty conference with some great material.
Chris, let me ask you about that volatility of volatility for a second, because I know that was a topic of conversation. It always is a topic of conversation at every RMC. And we haven't had you on the show in a while to kind of get your opinion on this. We've heard a lot of debate of late, particularly in the last year or two, about how the reduction in the number of large-size institutional participants, market makers, liquidity providers, call them what you will, in the options and derivatives and indeed the underlying world, has contributed, exacerbated, if you will, this new volatility regime that we're in, and that essentially we're doomed to have essentially a higher level of structural volatility going forward, because there are just fewer players in there to actually backstop the market and maybe cool things off, slow things down on a day like August 24th. And like I said, this has been a popular theory. It's been bandied about for a while. I'm curious what your take is on that.
Yeah, the liquidity gap theory is a really interesting point as a driver of vol. I think if you look at vol, so vol reached implied vol reached an all-time high, obviously this August, but it was tracking realized. I mean, it tracked realized vol pretty well. So the question then comes down to the underlying S&P. Why is the S&P moving so erratically, up and down that way? And that maybe gets into something beyond just the options market, and the absolute levels of liquidity are really interesting. I mean, this has been one of the only bull markets in history where we've seen liquidity decline. Usually, it's the opposite. So I think the idea that you have vol exploding one minute and then down the next minute, in this kind of schizophrenic behavior, might point to some sort of a general liquidity gap in markets, where normally there'd be some sort of a fill-in and a regime shift where that's not quite happening. You're getting these kind of epileptic seizures and recoveries. It's an interesting theory. It's hard to kind of pinpoint, though. This is the problem with all this, is that if you're not a dealer who is able to see all this massive flow, it's very hard to find quantitative evidence to kind of back any type of theory as to how the liquidity and interplay is kind of coming into play, and how that's affecting vol at the end of the day. I think you have to be a guy who has a bird's eye perch on the entire market to be able to see that. So that's been one of the struggles that we've had, being a hedge fund out here in Austin, is how do you see all that flow information to be able to really quantify some of these ideas.
Yeah, people typically point to the exacerbation of those moves, like you mentioned, with equating them back to Pearl Harbor, and that we're seeing more of those at a certain frequency these days. But of course, like you mentioned in your paper, there's a lot of other factors at work that could be driving that as well. So you can't really draw a direct causal relationship between X firm stepping out of the liquidity providing business and this correlating increase in volatility. But you're right, it is a fascinating theory, and I think we'll see some more data coming on it down the road. We got a few minutes left here. I want to make sure we get a little bit of our traditional volatility review in here before we wrap up the show. A lot going on from just a pure volatility perspective, getting away from the research and everything else. Very active week, as Mark alluded to there at the top of the show. We're recording this, of course, middle of the day here on Friday, December 4th, for all of you there playing the home game, and we are in rally home mode on the street. The market liking what it saw out of the non-farms and everything else. Of course, we had non-farm payrolls this morning. We alluded to on our option block program yesterday that they were buying all the vol. Of course, that was also, as what Chris referred to, with the news coming out of Europe, driving that pronounced sell-off and that firming up in volatility. Non-farms this morning now being in the rearview mirror. We're seeing the market up about nearly 2% across most of the major indices. And of course, all that bid that came rushing in to implied vol now coming out. VIX Cash hovering right around the 15.5 level, off about 2.5 handles. The VIX futures moving commensurately. So, Mark, we got a few minutes. We'll start with you. What's really catching your eye this week from a vol trading and analysis perspective?
I mean, I think that let's call it a massive short squeeze in the euro currency was pretty shocking yesterday. You think that if you think that markets were like disappointed by what Draghi had to say, you should have seen the currency market. The Euro USD made a massive multi standard deviation move, moving over 3 cents in a day. That is just shockingly large. And the crazy part is, and this is to maybe Chris's point, is then now they're coming in and they're dumping volatility on the euro currency. I can buy March vol for 10%, and it's been moving over the last 3 months, well over 10%, and there's been some pretty effective, some pretty hardcore moves, and that's discounting the move yesterday, which was just shocking. In addition, we've seen the VIX volatility of VIX flying around left and right. The futures have a really high volatility. VVIX has been moving around. I think the last 2 days it's been up and down 10%. They've come in and just pummeled VIX options, and the S&P. I mean, talk about down, up. Pretty crazy.
I think VVIX hit near 110 yesterday before settling down around the 90 level today. So VVIX back up in rockin' and rollin' mode as well. Russell, I know you've been busy traveling the globe and checking out the new Options Institute over there in Singapore. So maybe you haven't had too much time to watch the markets, but anything of note catching your eye this week?
We're up 2% on the SPX right now, and VIX has got a 15 handle.
Think about that. We were up.
I mean, that's the thing that but that's just the thing that continues to whenever we get these big rallies, if we step back 2 years and you're seeing the S&P 500 up, that much, VIX is a tween. It's in the 12 or 13 range. So the higher floor that we seem to have for VIX continues to catch my eye. I know I haven't been watching from day to day, so I got to go with that one.
Maybe that speaks back to that higher structural level of vol that perhaps a lot of people are speculating is in the marketplace these days. Chris, same question to you. Obviously, a lot's been going on this week, both with Europe and with the Fed and with non-farms this morning. So we've seen a lot of volatility action this week. What in particular caught your eye in this week's activity?
I mean, I think the move. I think you guys hit on it. The movement to the VVIX has been just fascinating to me. I mean, that type of extreme range up and down is pretty interesting. So that's what I've been watching, and I think really the outperformance and underperformance on the outperformance and the sensitivity of the front future compared to where the back has been also pretty interesting. So the outperformance of the front versus the movement on the back of the futures term structure, which is really gauging the expectations as to what is going on in the immediate term versus whether or not the market actually thinks we're going to be in some sort of a rate hike cycle or not. So that steepness on the back of the curve is pretty interesting in terms of giving an indication as to whether the market thinks that what we're going to be experiencing going forward into the next year. So I mean, if you look at June, July, there's been a tremendous amount of steepness versus relative flatness on the front of the curve, and that's kind of indicating that there's an expectation of strong turbulence next year.
Yeah, we could probably do several shows just on. We do quite a bit on just the vagaries of the VIX futures term structure. That could be a whole show unto itself. But you're right, it has been a lot going on out there, and certainly worthy of note as well. Speaking of worthy of note, as we're getting into the end of the show here and most of the way through the session today, even though a lot going on in the broad market, like we mentioned, S&P rallying 2%, vol coming in aggressively, not a heck of a lot of paper lighting it up out there in the VIX options land, about 350,000 contracts so far today, so probably still going to be well below the ADV, which is surprising given everything going on in the broad market. Sometimes you kind of scratch your head as to what's driving the paper out there in these products, but as you alluded to, Russell, it's a bit of a head scratcher out there. Market up 2%, we're still in a 15-plus handle in VIX, so we're in a bit of a new Wild West from a vol perspective. And before we wrap up here, let's roll right into our final segment, really quick, Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball segment. Like the man says, this is the portion of the show where we put on our Karnak hats and we attempt to divine what the volatility gods hold in store for the near future, not too far away, just a week or so out. That's challenging enough. I could feel Buzz Gregory's pain having to try to prognosticate on an entire year from a vol perspective. We have enough of a hard time just doing a week ahead. Chris, since you're our guest, I will give you pride of place, sir. Looking forward, all the things we have unfolding in the world of volatility. We have the Fed, we have non-farms today, of course. We have the ever-varying term structure out there in VIX futures. We have this super moral hazard effect we were talking about earlier in the show. A lot of things at work in the volatility market right now. All that summed up in about 20 seconds. What's your best prognostication, your best Karnak for where we'll be at this time next week, showtime, from a VIX Cash perspective?
Next week?
Just 1 week out, sir. That's all we ask.
Oh, boy. You know what? That's just a roll of dice. So
that's the fun of it.
Yeah, that's the fun of it. So why don't I say next? Let me go out a little farther. Let me go 1 year, right? Let me go 1 year. I think what we're looking at right now, and I think 1 year is more fun. So I'm going to break the rules. I think this environment sort of reminds me a lot of 97, 98. And I wouldn't be surprised, given the dovishness of central banks, that we see a period more retest of 40 in the VIX going forward in the next year, but that the equity market continues to perform. So that period, 97, 98, that was a high period in vol. VIX averaged over 20, but it was also a tremendous period for equity returns. So I think we're transitioning from a high equity return, low vol period to maybe what might be a high equity return, high vol period. I think that's might be pretty interesting to see.
Mm-hmm. Yeah, Chris, when I look at this last year, doesn't it look, if you look at what VIX did and how the market performed, doesn't it kind of have a little bit of a 2007 smell to it as well? The market may be inching higher, and the average VIX price markedly higher than the year prior. I do, and also the last time that Fed was actually kind of actively raising rates, doing things like that. Do you get a little smell of that by any chance?
Yeah, I think it's a really interesting point, and that was brought up actually at some of the dinners that I had with some of the other traders over at the conference in Hong Kong. I think it's a great point. I think that when I look at this environment, though, I think what makes it more similar to 97, 98 is sort of the macro backdrop where the things that are causing vol events are not emanating from domestic credit, but they're emanating from overseas turbulence that then spills over into contagion and U.S. dollar strength. That's kind of so. It's interesting. I've heard the 07 analogy quite a bit, but I kind of personally feel that maybe 97, 98 is a good kind of overlay. It doesn't necessarily mean we go into a world of complete collapse, but maybe it means we should, but that they'll probably forestall it. I think it all depends. The keys are with the central banks. So, but I think it's a great point, Russell. I mean, I really do. So, so as far as next week, boy, I don't know.
It's all right. We'll stick with your 1 year.
Right where we are now.
We'll stick with your 1 year prediction there. And since Chris broke the rules, that's going to actually have to do it for our crystal ball. It's all the time we have this week as well. So he actually spared you guys from having to humiliate all of us from having to humiliate ourselves once again with some sort of crazy pick, as Chris would say, the roll of the dice. So that is going to do it for the crystal ball segment. It's also going to do it for this episode of Volatility Views. But before we go, really quickly, let me check back in with my cohorts here on the Volatility Views panel, see what they have in store that may interest you. Chris, I already mentioned ArtemisCM.com, where our listeners can go to check out that white paper and read it for themselves. Anything else you want to tease that's coming up at Artemis? The floor is yours.
Oh, I've spent too much time, so I'm just happy to be here. Thanks for the opportunity again.
Russell finds that deeply humorous.
I do. Well, it's 3:00 in the morning. Everything's funny at 3. Nothing good happens after 3 a.m. and everything is funny, I guess. So, as far as I've got it this next week, we're opening an options institute in Singapore, doing the first class, beginning options class, on Wednesday the 9th. And then I get to come home and not travel for a month and finish up my next VIX book. So that's what I got going on.
Well, congratulations on that, sir. I look forward to hearing about all the fun education coming out of Singapore. And last but not least, Mr. Sebastian, what's going on in the land of Option Pit as well as with Carmen Line Capital?
Oh, things are great. Doesn't get any better than where they are now. Yeah, we're in the middle of wrapping up our second round of funding at Carmen Line Capital. Things are going pretty well for us. Yeah, Option Pit, things are rolling along. We're loving what we do. So we're happy to be here, like Chris said.
Always nice to love what you do. And on behalf of Mr. Greasy Meatball and Russell, who has no nickname, and Chris, who I guess we can call him for today, the volatility moral hazardist, and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Didn't get a chance to get to them today, but I'm sure you don't mind. We had some pretty fascinating discussions. We'll get to them more on the next episode, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.